Welcome back, everyone. We have heard a couple of strategies for protecting yourself and profiting during a double-dip recession, but how are money managers dealing with the slumping economy and unpredictable markets on a day-to-day basis? Joining us to answer that question is Steve Chapman. He is the Vice President of Weiss Capital Management. Hello, Steve.
Hi, Jamie.
Also, John Brown is here as well as the Senior Market Strategist at Euro Pacific Capital. John, how are you, sir?
Jamie.
All right, Mike Larson told us earlier he thinks another recession is now inevitable. Steve, I want to start with you. Do you agree?
I agree. I think all the years, decades virtually, Jamie, of all the spending and the excess has to be wrung out of this system. And this deleveraging process is going to take a long period of time. And I think the trajectory of the market has been down. It will continue to go down. And it's not going to stop until the balance sheets get cleaned up. It's going to take some time. So I agree. A recession is coming, maybe perhaps even a depression as well. It might take that to flush the whole system back out.
John, Moody's came out last week. They said publicly they didn't think that we were going to be headed toward a double-dip recession. Do you agree with that?
No, I don't. I think when you look at unemployment figures, automobile sales down, and you look at housing, it looks like the recession is getting deeper. And I think actually we're in the initial stages of a depression. I think the consumer is in shock, and it's a matter of psychology. And of course, people like the Fed, like the government, like the Treasury Secretary, like Moody's, are trying to boost morale, in my opinion. But that's not what investors have got to look at. They've got to look at reality, and that's a little more bearish.
It is indeed. You know, with the upcoming elections and you know, I think there's a psychological level for the market that they have an interest in keeping the Dow above 10,000, and I think they will go to that extreme to do that. It has definitely implications on the electoral side, as well as just the psyche of the investing public. And I don't trust the moves. I think that you can't stop a cycle. We've had a spending boom for years and years, and now we've got to clean up, and it's going to take a while to do it.
And you can't change a psyche overnight. What is left for the Federal Reserve to do?
Oh, I think they've got some things to do. They could stop paying interest on reserve deposits from the banks. They could even charge a negative interest. In other words, they could charge banks with some of that, would push more money out into the system. They're still very powerful, the Fed, and they've got quantitative easing. They could do it. Seems like they've got limitless amounts of power to do whatever they want in quantitative easing. It could be in trillions of dollars. And of course, they can talk and people listen to the Fed. So it is still very important, but their ammunition's running dry. I mean, the interest rates can only now go negative, basically.
Yes.
And so they've used a lot of their powder.
I agree. I thought it was interesting that they met in Jackson Hole, because indeed they are in a hole, and you know, and they don't know how to get out. And the only way they get out is just to keep printing money, and that is just going to dilute not only the value of the outstanding dollars, but it's going to exacerbate a problem. You can't drink yourself sober, and you can't print yourself out of a deficit, and that's where we are.
Yeah, I agree with that, and I think basically the amount of money is so little. When you talk with the Fed, if they did an injection or quantitative easing of $2 trillion, it would shock people.
Yes.
But relative to the $14 trillion that's been taken out of the aggregate of consumers' balance sheets, it's still a small figure. I mean, consumers are in shock, and you have a psychology for hyperinflation, you have the reverse psychology for depression, and I think we're in the initial stages of that.
The Obama administration at this point seems to have two strategies on the table: deficit reduction, stimulus programs. Which should they pursue?
Well, the appropriate way, I think, is to reduce the deficit. But again, that is not the method they use to get reelected. So it's like the politician says, you know, we know what to do, but if we do it, we just can't get back in office again. So I would say, prudence would say reduce it. But I don't think that they'll resort to that. So that's certainly not the popular way, and it certainly is a lot more of a painful option to reduce some of the entitlement programs, reduce the expenditures. We need to do that. We need to do it at a micro level in our own families, and we need to do it at the governmental level as well. But I don't think they'll do that.
Well, Steve is absolutely right, and that has been the path, but I think there may be a change. I think the Tea Party indicates that grassroots America is absolutely fed up with the willful overexpending by governments. And they're starting to, even within the Republican Party, change candidates from spending candidates to cutting candidates. And so I think for the first time it's a major move. You know, it hasn't happened probably twice in American history. Such a powerful grassroots movement to really make politicians, for once, do the reverse of what Steve is thinking. You say, well, that used to be the old game, but the new game is, my gosh, if I'm not seen voting for cuts, I'm going to be out at the next election, maybe even kicked out by my fellow party members. And so I think there's a grassroots pressure for cutting spending, and that would be terrific, because out of that you could also cut taxes.
Yes.
As I've always recommended, a 3-year tax holiday for everyone, no ifs and buts, all companies, all people. It would still be minute compared to the deficits and things that they're running for the wars. And that would be a real incentive, because individuals spend their money in an individual way.
Yes.
So if they had the freedom to spend that money, companies and individuals, I think that would act as a really effective, the most effective type of stimulus. The government spending ones are notoriously expensive. Like, they cost roughly $2 for every dollar that the government spends. $2 is sucked out of the private sector. They're wasteful. Government spending is almost always very, very wasteful. Wide open to fraud, and of course targeted at the wrong things. Politicians do not make good business decisions. As Steve said, they make political decisions.
Yes.
And those are almost usually, almost always bad economic decisions.
Steve, you are a money manager. You deal with it on a daily basis. Let's talk about conservative investors now. How should they be playing this? And let's switch off of what should happen here from the political side to what is going to happen with investors in mind.
That's a great question. I think the way we're playing it right now is extremely conservative. John is right. What will they do what they need to do, or will they do what is the expedient thing? So I would rather prepare and configure for adversity. We don't know how deep this recession is going to go, depression is going to go. I don't think that you need to take any amount of risk more than necessary, absolutely necessary. The fact is that the risk-reward is so lopsided, and from a business perspective, a lot of these investors lost a tremendous amount of money in 2008. And so their portfolios were damaged 30, 40, 50, 60%. And then the other source of their wealth has been in the housing. And that has been basically vaporized as well. So the individual is just shell-shocked. And my concern is that part of what keeps a market going is confidence, and investor confidence. And it's been shattered, it's been dashed. And until this confidence comes back, I think we need to play it very close to the vest, very conservative. Income is king right about now. I think if from a business standpoint, if the market's upside is 5 or 10%, maybe on a brief stimulus, the downside could be 30 or 40%. I'm not willing to take that risk with my money, with my clients' money, with my own personal money. So,
John, what should we do here? Keep wheelbarrows of money locked under key here?
Yeah, well, always in deflation, cash is king.
yes.
And in inflation, buying assets is the great thing, and having minimum cash, in fact, borrowing to spend more money on assets, which all rise in price with inflation, is a great strategy. The reverse happens in deflation. One should be shedding assets and hoarding cash. I believe real cash, like precious metals. And I think what we're going to see is increasing austerity, increasing threat of defaults, including government defaults on debt, and basically, as Steve said, great uncertainty, which there is already, but increasing uncertainty, and that will be reflected in extremely volatile markets and a volatility which is tending downwards. It'll trend downwards, in my view.
There is also opportunity, however, in an economy like this. Real estate may be down, but it's also an opportunity to buy. What other investment opportunities are there for aggressive investors?
For aggressive investors, I think what you need to do, regardless of what you invest in, is you buy it and you have to watch it. The time compression is so intense today, and something that could be a good investment for an opportunity for a month or two, that window could close. It needs to be, you need to trade it. You need to be very active in that. You expect to get whipsawed, because it will happen. And if you can put up with that and your nerves can stand it, I think you could buy, equities or this type of thing too. I find most people, though, most people do not want to embark in that. They've gone through 10 years of the S&P basically doing nothing, when really a 90-day T-bill wins the race after all that neurotic market activity. So again, on top of the housing and this type of thing, I would say stay conservative, as John points out. But equity investments, out of 20,000 mutual funds, I run the mutual fund sections of our strategies. There are probably no more than 200 I would even consider buying today.
Last word to you, John.
Well, basically, buy and hold used to be a great strategy in the good old days.
Yes.
Today, as Steve said, I think the key word is flexibility, even for the aggressive player, particularly for the aggressive player, actually. And I think, therefore, if you go into markets, equity markets, they should be non-dollar, basically in emerging markets, and the suppliers of those emerging markets, like the raw material countries like Brazil, Canada, Australia, New Zealand, that supply China and India with raw materials and other things, and food, and so on. Those are good equity areas to be in, but on a very flexible basis, be quick to get out. And I think, of course, for the really aggressive investor, shorting some of the conventional markets, like maybe the US stock market and so on. But that's dangerous, shorting. But if you buy the ETFs that are short, it's a lot less dangerous. I mean, that's for the aggressive player.
Yes.
All right, John Brown of Euro Pacific Capital and Steve Chapman of Weiss Capital Management, thank you both for being here.
Thank you, Jamie.
Thank you very much, Jamie.
Coming up next week, we're going to focus on one market many experts say you should pay attention to over all others, and that is the currency market. Why it controls everything from geopolitics to the value of your individual investments, and why the world's most important currency right now may not be paper at all, but gold. If you have a question or a comment about this week's topic, feel free to email us at weissmoneynetwork@weissinc.com. We're reading everything that comes in, and while we may not be able to address them all on air, we're keeping them at hand for future shows. That does it for this episode of Money and Markets. I'm Jamie Holmes, and now, Martin Weiss.
If you've been watching Money and Markets TV from the outset, you've known a few things that most investors missed. You were among the first to hear about the double-dip recession. Back in July, Mike Larson stepped up to the plate and told you, without any vacillation or trepidation, that we are sinking quickly into a double-dip recession. He told you why, how, and when. At that time, few pundits were even considering the possibility of a double-dip recession. Now, except perhaps for Washington officials scrambling to talk up the economy and to save their jobs, there are few who see the possibility of avoiding a double-dip recession. You were also among the first to get very specific instructions on what to do to escape the dangers and even profit from the decline. Most important, please remember this. A double-dip recession and a stock market decline will be painful, but it will not be the end of the world. Here's a good metaphor. In the context of the housing bubble and bust, back a couple of years ago, we said that falling home prices were not the problem. They were actually part of the solution. They helped to make homes more affordable for more Americans, and ultimately, they can pave the way for a real recovery later. Likewise, today, in the broader context of the entire U.S. economy, I can tell you flatly, the double-dip recession is not the fundamental problem for our country that many people think it is. Yes, it will be very tough, but in the long run, it can also be a part of the solution, helping to open a path for new, innovative companies, helping to restore the basic ethic of hard work and savings that made our country great, and helping to lay the groundwork for a more wholesome recovery down the road. There's only one warning, however. The recession must be allowed to run its course. To the degree that the government intervenes again to stop it from happening now, it will only prolong the agony in the future. I'm Martin Weiss for Money and Markets TV. Thank you very much for watching.